If you pay taxes, you've probably asked yourself how much of your tax money actually comes back to you. Every year, millions of Americans see taxes taken out of their paychecks and wonder where that money goes. By the end of this video, you'll have a clear picture of which taxes come back to you, which ones might come back later, and which ones fund things you may never directly use. Before talking about numbers, we need to define what goes to you directly actually means. When we say taxes that go to you directly, we are talking about benefits that meet at least one of these conditions. You receive cash payments, you receive insurance coverage, you earn guaranteed future benefits, you receive services tied specifically to you as an individual. This does not include general government operations, national defense, or interest on the national debt. Those may benefit society broadly, but they are not personal returns in the way we are defining here. Most Americans pay three main types of federal taxes: income taxes, payroll taxes, and indirect taxes like excise taxes. Each one behaves very differently when it comes to what you get back. Let's start with the most direct part of the federal tax system: payroll taxes. These are the taxes you see on almost every paycheck. They are taken out automatically. You do not choose when to pay them. You do not file deductions to reduce them. They apply to nearly everyone who works. Payroll taxes fund only two programs: Social Security and Medicare. Together, these are often called FICA taxes. If you are an employee, 6.2% of your wages goes to Social Security. 1.45% goes to Medicare. That adds up to 7.65%. Your employer pays the same amount on your behalf. Even though you do not see it, it is part of your total compensation. If you are self-employed, you pay the full 15.3% yourself. Here is the key difference. Payroll taxes do not go into the general federal budget. They are legally dedicated to specific programs. When you pay payroll taxes, you are not funding government offices. You are not funding defense spending. You are not funding interest on the national debt. You are funding benefits that are tied directly to individuals. That makes payroll taxes the most direct return most Americans ever receive from the tax system. The easiest way to understand payroll taxes is to think of them as a combination of insurance and forced savings. They function as retirement income insurance, disability income insurance, survivor protection for your family, and prepaid health insurance for later in life. You do not have a personal account with your name on it, but every year you work, you earn legal eligibility for future benefits. That eligibility is written into law. Each year you pay payroll taxes, you earn credit towards Social Security retirement benefits. You also earn protection under Social Security disability insurance. If something happens to you, your spouse or children may qualify for survivor benefits. And over time, you earn access to Medicare health insurance. These benefits are not optional. They are not based on income once you qualify. They are not decided year by year. They are automatic once eligibility rules are met. When people ask, "Do my taxes come back to me?" Payroll taxes are the clearest answer. If you work, you are paying into programs you are extremely likely to use, especially Social Security and Medicare. For many Americans, these programs return more in lifetime benefits than the total payroll taxes paid during their careers. That does not mean the system is unlimited. And it does not mean benefits are guaranteed at the same level forever. A significant portion of your taxes are not disappearing. They are deferred benefits, they are insurance, and they are tied directly to you. That is why payroll taxes sit at the center of any serious discussion about how much of your taxes go to you directly. Now let's talk about Social Security. Social Security is the single largest program most Americans will ever personally receive benefits from. It is also one of the most misunderstood. Social Security is not welfare. It is not a savings account. And it is not optional. It is a national insurance system funded primarily through payroll taxes. Social Security pays benefits to three main groups: retired workers, people with long-term disabilities, and surviving family members. If you work and pay payroll taxes, you are building eligibility for all three. The largest part of Social Security is retirement benefits. When you retire, Social Security provides monthly payments for the rest of your life. These payments help cover basic expenses like housing, food, and utilities. For many retirees, Social Security is their primary source of income. For others, it supplements savings and pensions. Benefits are adjusted for inflation. That means payments rise over time to help maintain purchasing power. Social Security also includes disability insurance. If you become unable to work due to a serious medical condition, Social Security disability insurance may replace part of your income. This protection exists even if you are far from retirement age. It is one of the most valuable but least understood parts of the system. Social Security also provides survivor benefits. If a worker dies, their spouse, children, or sometimes parents may receive monthly payments. These benefits help families avoid sudden financial collapse after the loss of income. Again, this protection is earned through work and payroll tax contributions. You do not earn Social Security benefits by investing money in an account. You earn them by working. Each year you work and pay payroll taxes, you earn credits. Once you earn enough credits, you qualify for benefits. The amount you receive depends on your lifetime earnings, not on how much you paid in a single year. When people ask how much of their taxes go to them directly, Social Security is central to the answer. If you live long enough to retire, you are almost certain to receive benefits. For most Americans, the total value of lifetime Social Security benefits far exceeds what they paid in payroll taxes late in their careers. That does not mean everyone gets back more than they paid overall, but it does mean this. Social Security is not abstract, it is not indirect, and it is not optional. It is a direct personal benefit earned through work and backed by law. Social Security explains why many people feel conflicted about taxes. They may dislike paying taxes now, but they rely heavily on benefits later. This program alone accounts for a large share of taxes that go back to individuals. And that is why Social Security is one of the clearest examples of taxes that go to you directly. Now, let's talk about Medicare. Medicare is federal health insurance primarily for people aged 65 and older. It also covers some people with disabilities. Most Americans do not think about Medicare until they are close to retirement, but you begin paying for it from your very first paycheck. Medicare is funded largely through payroll taxes. 1.45% of your wages goes to Medicare. Your employer pays another 1.45% on your behalf. If you are self-employed, you pay the full amount yourself. Unlike Social Security, there is no income cap on Medicare taxes. That means higher earners continue paying Medicare taxes on all of their wages. When you become eligible, Medicare helps pay for healthcare costs that would otherwise be extremely expensive. This includes hospital stays, doctor visits, preventive care, and prescription drugs. Medicare does not cover everything, but it significantly reduces medical expenses during retirement. For many people, Medicare makes retirement possible at all. The best way to think about Medicare is as prepaid health insurance. You are not building a personal savings account. You are buying into a national risk pool. You pay in while you are working, you receive coverage when you are older, and health costs are highest. This system spreads risk across generations. It also protects individuals from catastrophic medical costs later in life. When people ask whether their taxes come back to them, Medicare is a key part of the answer. Even if you are healthy today, you are almost certain to use Medicare in the future. Healthcare costs rise sharply with age. Without Medicare, many retirees would face financial ruin from medical bills. That means Medicare is not abstract spending. It is a direct personal benefit earned through payroll taxes. For most Americans, the value of Medicare coverage over a lifetime is far greater than the Medicare taxes paid during working years. That does not mean Medicare is free, and it does not mean the system does not face challenges. A significant portion of your taxes is paying for health insurance you are extremely likely to use. That makes Medicare one of the clearest examples of taxes that go to you directly. Now let's move to income taxes. Income taxes work very differently from payroll taxes. Payroll taxes are dedicated. Income taxes are flexible. They fund many parts of the federal budget. But some income tax dollars do come back to individuals as direct cash or near cash benefits. A direct cash return is money that goes back to you personally. This can happen in two ways. You receive a payment, or you receive a tax refund that is larger than what you paid in. These returns are most common through tax credits. A tax credit reduces your tax bill dollar for dollar. Some credits are refundable. That means you can receive money even if you owe no income tax. Refundable credits are the clearest example of income taxes going back to people directly. One of the largest refundable credits is the Earned Income Tax Credit. This credit is designed for low and moderate income workers. If you qualify, you may receive a refund that exceeds the income taxes you paid. For many households, this means income taxes are not just collected, they are returned as cash. Families may also receive cash through child-related tax credits. These credits reduce taxes owed, and in some cases, they result in direct refunds. For families with children, this is often the largest source of direct tax returns. Some income tax dollars also come back through education credits. These help offset the cost of college and training programs. They may reduce taxes owed and sometimes result in refunds. For students and families, this is another direct return from income taxes. Unlike payroll taxes, income tax returns depend heavily on eligibility. Two people earning the same income can receive very different outcomes. One may pay net taxes, another may receive a refund. This is why income taxes feel confusing. They are not uniform, they are targeted. When people ask how much of their taxes go to them directly, income taxes are often overlooked. That is because people focus only on what they pay in April. But refunds and credits matter. For millions of households, income taxes provide real cash support, not indirectly, not in the future. But right now, in this way, income taxes function partly as an income support system. They adjust based on earnings, they adjust based on family size, and they adjust based on life circumstances. That makes income taxes another path through which tax dollars go back to individuals directly. Now let's talk about unemployment and income support. This is one of the most visible ways taxes come back to people directly, but it is also one of the most misunderstood. Income support refers to programs that provide money when regular income stops or falls. These programs are designed to help people get through temporary financial shocks, not permanently, and not without conditions. The most familiar example is unemployment benefits. When someone loses a job, unemployment benefits provide temporary income support. This helps cover basic expenses like rent, food, and utilities while the person looks for new work. Federal taxes help fund this system, especially during economic downturns. Job loss can happen suddenly. Even people who plan carefully can lose income overnight. Unemployment benefits act like insurance. You may never need them, but if you do, they can prevent immediate financial collapse. That protection is a direct return on taxes paid over time. Income support also includes other programs that provide cash or near-cash assistance. These programs help people who are disabled, have very low income, are caring for family members, or are facing temporary hardship. These benefits are targeted, they are means-tested, and they are usually temporary. Not everyone uses income support programs, but almost everyone benefits from their existence. They stabilize households, they stabilize communities, and they reduce the economic damage from job loss and illness. For people who do receive benefits, the return is immediate and personal. These programs provide cash when income stops support during emergencies and time to recover financially. That makes them one of the clearest examples of taxes returning directly to individuals. Even if you never need them, they are part of the system your taxes support. And if you ever do need them, the value becomes very real. Now let's talk about education and student aid. This is another way tax dollars return to individuals directly, not always as cash, but as reduced costs and expanded opportunity. Education aid includes programs that help people afford learning after high school. This includes grants for college students, subsidized student loans, interest benefits on loans, and loan forgiveness programs. These programs are funded by general tax revenue. Some education aid comes as grants. Grants do not need to be repaid. They reduce tuition costs and other education expenses. For students who qualify, this is a direct financial benefit. It lowers the amount they must borrow or pay out of pocket. Other education aid comes through student loans. Some loans are subsidized. This means the government pays interest while the student is in school or during certain periods. That interest payment is funded by taxes. Even though no cash changes hands, the benefit is real. Lower interest means lower total repayment. Some borrowers also qualify for loan forgiveness or income-based repayment plans. These programs limit payments based on income. In some cases, remaining balances are forgiven. This reduces long-term debt. Again, this is a direct financial benefit funded by taxes. Education aid matters most for people early in life, students, young adults, and families supporting education. The benefit may not arrive as cash, but it arrives as lower debt and lower future payments. When people think about taxes, they often think only about current income, but education shapes future income. Lower education costs can lead to higher lifetime earnings and less debt. That makes education aid a direct investment in individuals. Education aid is often overlooked because it is spread out over time. You do not always see a single payment. You see lower bills, lower interest, and less debt. But those differences matter. They change financial outcomes for decades. Education aid is not universal. Not everyone uses it. But for those who do, it is one of the largest direct returns they will ever receive from the tax system. That makes education and student aid another important way tax dollars go back to people directly. Now, let's talk about the other side of the question. Not all taxes go back to you directly. In fact, a large portion of tax revenue funds, things you may never personally receive. This distinction is important. Some tax dollars pay for the basic operation of government. This includes federal agencies, administrative staff, regulatory enforcement, and day-to-day operations. These costs keep systems running, but they are not personal benefits. You are not guaranteed a measurable return from them. A significant portion of taxes fund national defense. This includes military personnel, equipment and operations, and national security activities. Defense spending may benefit society broadly, but it is not tied to individual use. Most people will never receive a direct personal benefit from it. Another major expense is interest on the national debt. This money pays lenders who hold government bonds. It does not fund services. It does not provide benefits. It exists because of past borrowing. This is one of the clearest examples of tax dollars that do not return to individuals directly. Taxes also fund infrastructure, roads, bridges, airports, and public facilities. You may use some of these, you may never use others. The benefit is indirect. You are not guaranteed a personal return equal to what you pay. Some tax dollars fund research, medical research, science and technology, energy and space programs. These investments may benefit future generations, but they are not personal benefits you can claim or receive. When people ask how much of their taxes go to them directly, this category explains the frustration. Some taxes fund shared systems. Some fund long-term goals, and some fund past obligations. These uses are real, but they are not personal returns. Understanding this difference helps clarify the debate around taxes. Some taxes act like insurance, some act like savings, and some act like shared costs. Not every tax dollar is meant to come back to you personally, and that is by design. This section helps separate personal returns from collective spending. That clarity matters when evaluating how the tax system really works. So, how much of your taxes go to you directly? The honest answer is not a single number. It depends on who you are, where you are in life, and what happens along the way. But some conclusions are clear. First, not all taxes work the same way. Payroll taxes are the most direct. They fund Social Security and Medicare, programs you are very likely to use. These taxes act like forced savings and insurance. Income taxes are more flexible. Some of them return as cash, some return as reduced costs, and some fund protections you may only notice during hardship. Second, many tax benefits are delayed. Some returns arrive quickly, refunds, credits, income support. Others arrive much later. Retirement income, health insurance in old age, survivor and disability protection. The delay makes the connection harder to see, but delayed does not mean unreal. Third, some taxes never return personally. Some taxes fund shared systems, defense, infrastructure, research, and interest on past debt. These costs support society as a whole, but they are not personal benefits. Recognizing this difference matters. Fourth, taxes are not just expenses. Many taxes function as insurance. They protect against risks that are hard to plan for alone. Job loss, illness, disability, long life. You may never need every program, but the protection exists because everyone contributes. Some of your taxes come back as cash, some come back as services, some come back as insurance, and some never come back to you personally. All of these roles exist at the same time. Focusing on only one misses the bigger picture. Your taxes are not simply disappearing, they are doing different things at different times for different people. Understanding where your money goes does not tell you what the system should be. but it does tell you what the system is. And that understanding is the foundation for any informed discussion about money, taxes, and personal finance.